This is the Real Wealth Podcast, where we explore all things wealth related. Join us on this wealth journey. Let's get into it. Welcome to the Real Wealth Podcast. I'm Alex Robertson, I'm your host, and in this episode I'm going to be giving you an insight into one of our training courses, our online Zoom, as part of our master's degree in buy-to-let investment. This week's subject, I'm talking all about property investment tax. It's never been more difficult to invest professionally as a property investor and make good money. So it's so essential that you get yourself educated, and this is one of the key elements that we talk about in terms of tax, because the government has been on a run over the course of the last 5 years in terms of landlords and maximising the amount of tax that they can get. So if you don't understand the fundamentals, there's a high chance that you can make some big mistakes at the start of your property investment journey. So if you're interested in pursuing wealth creation through property investment, one of the foundational elements you need to understand is tax. And in this episode, I'm going to go through 5 or 6 of the key areas that you need to focus on when you're investing in property. All right, guys. I mean, tax is one of those things that, it seems to be hugely boring. I'm always the tax guy because I'm an accountant and, I talk about it a lot. And the reality is I fucking hate tax, but it is a huge part of everybody's life and most people are completely oblivious to this. So it's a really important part of your journey towards entrepreneurship in general, not just in property investment, that you develop a base level knowledge of tax, because most people go through their life not understanding anything about it. And as I put in my recent rant on my social media, up to 70% of every pound you make as an employee goes back to the tax man through various different forms of tax. Through income tax is the obvious one, where even someone on an average salary of 30 odd grand a year is paying 22% of tax and national insurance before they even get their salary. And then you get your salary, you're going to spend it, you're going to buy a house, you're going to pay a bunch of transaction tax on that, you're going to live in the house and you're going to pay council tax there. Then you're going to buy a car and there's VAT on that. The company that builds the car has to make a profit, and then there's 25% corporation tax within that. And then you need to put fuel in it, and up to about 75% of what you pay at the pump is taxes and duties, and in one way or another. You go to the supermarket, bunch of VAT on all that stuff. There's a bunch of importation tax because most of it's coming from abroad. When you start stacking all this up, you're paying a huge amount of tax. And the reality is, for most employees, there's fuck all you can do about it. There's very little you can do. It's only as you get into owning your own business and having entrepreneurship you can actually do something about it. And it really pisses me off, because the government is taking somewhere in the region of 1.2 trillion of taxes every year. And a lot of it is just getting spunked. There's 300 billion every year going to the NHS that's a fucking mess and you can't get an appointment. There's 120 billion of your tax money that just goes to service the debt that they're in, and that's in the trillions. If they were a company, they'd be insolvent, the directors would be going to jail, because you can't run a company insolvently, but apparently you can run a government indefinitely insolvently. So the tax system is a massive fuck up in the UK, and there's a thing called the Laffer curve that says, it's essentially a curve that says there is a specific point in taxation, a specific percentage of tax that you can charge people that will make sure as a government that you're receiving the maximum amount of tax you can. And then once you go above that and keep going higher, your tax drops off. You start getting less because people leave the country, or they start to evade taxes and do all sort of nefarious stuff. The UK is well beyond that threshold. You're talking somewhere in the region of 30 to 40% tax being the optimum for the government to receive the most tax. There at 70, it's just a complete shit show. So anyway, that's my rant over with the general tax system fuck up. The beautiful thing about it as entrepreneurs is quite a lot we can do about it to avoid tax, and property is one of those things that has been heavily legislated against over the last 5 or 6 years. Particularly is worse in Scotland because ultimately the government doesn't like landlords, and they certainly don't want any non-professional landlords. So it's critically important now as a landlord, particularly in Scotland, do you understand the basics of tax and where you're likely to be hit if you don't structure it right. So that over, the stuff that I'm going to cover tonight, fairly high level. is corporate structure in section 24, and I think most of you will be familiar with that because it's usually the first thing that people learn about when they start to look at property investment. It was announced in 2015, they started introducing it in 2017, and it's been about for a while now, so we'll talk about that in a bit. Revenue versus expenses is probably one of the most important tax avoidance strategies you need to know as someone that is in property investment. Not only that, someone that is in property investment to do BRR, buy, refurb, refinance, rent. That creates a huge opportunity for tax avoidance that we're going to go into, and you all need to understand that, because most accountants that aren't property professionals won't understand that, and it can cost you a lot in taxes. Other tax avoidance strategies which are great for people that are running through companies. Again, as an employee or a sole trader, you're very hampered in what you can do in terms of tax avoidance. When you have a company, there's a lot more you can do to avoid tax, and we'll talk about some of that. Efficient cash extraction, how if you've got a company, you can get the money out in the most effective way without having to pay a bunch more taxes. There is an example that I do of how you can get 30 grand out of the company tax-free. I'm not going to do that example tonight, but it is online. It is part of that module, and I will go through some of the key elements to that cash extraction strategy. I'm just not going to go through the full example here. It's a bit easier when I've got a whiteboard in front of me. Finally, we're going to talk a little bit about inheritance tax and a little bit of SAS, pensions, and tax benefits, and you may have covered that already in some of the content in the context of finance and raising finance, but I'm going to talk about it more specifically in terms of the tax benefits for a company or a business owner in using a SAS pension. Okay, so that's a broad overview of what we're going to be talking about during the call. Laurie, I can't see the chat box with this, so can you keep an eye on it?
That's cool. I've just opened it. I've got an eye on it, and if there's anything, I will chip in.
Okay, so the first thing when you're deciding to open your business is, what way are you going to structure it? How are you going to do it? And a lot of people that fall into property investment just buy their first property in their own name and don't really understand the implications of that. Obviously, we're going to talk about section 24. That is something that you cannot do right now. But if you were to do it and buy it in your own name, you're essentially a sole trader. If you buy it where the beneficial ownership is split between more than one person, it'd be a partnership, but effectively the same tax regime. You can create a limited liability partnership, which is sort of a hybrid between a partnership and a company. It's registered at Companies House. There are some more requirements. There are some more corporate protections for you. But ultimately, what we concern ourselves with is mainly the tax system. 90% of what you care about when you're picking a structure is what tax am I going to have to pay. And in this instance, a limited liability partnership, the tax falls under the individual tax system. So sole traders, partnerships, limited liability company, it's all the same tax regime, all affected by that section 24 that we're going to talk about later. And then finally, you've got a limited company. And when you're looking at these different types of structures, there are a few main things that you need to think about. Number one is always tax, and I'd say 90% of it's tax. Number two is liability. Now, with an individual, if you buy a property in your own name and you mortgage it, you are entirely liable up to the value of all of your assets. If you buy it through a limited company or a limited partnership, limited liability partnership, you would assume that there is limited liability, hence the name. But most banks will require that you sign a personal guarantee, which means essentially they break that protection that you have, because they understand that if everything goes tits up and you just want to walk away, you can throw the keys at them and they've got a problem to solve. They want to know that your personal assets are also on the line if whatever happens in the limited company or limited liability partnership breaks down. So whilst you technically have that protection of a limited company, in reality you don't, because your biggest liability is usually to the bank in terms of the property, and you will have to put personal guarantees down. It's just part of the game. You have to get used to it. If you're buying in your own name, you'd already have that level of risk anyway. So the liability thing doesn't come in too much into play of it when we're talking about investment, purely because these PGs exist. Lending options is a big one. When Laurie and I started out in our kind of property investment journey, Section 24 had just come in, so everybody was moving from being a sole trader to putting everything in a limited company. But in Scotland, the lending hadn't caught up, and there was very few lenders that were actually providing loans to limited companies. Most of the buy-to-let lending was happening through sole traders and people buying individually. So it took a while. We were really struggling to get refinances done in the early days because we just didn't have those options. But within a year or so, you went from having 2 or 3 options to having 10 or 11, and there is a much broader market now, as you guys will have seen, certainly the guys that have started to do deals already. There's a much broader market now for limited company lending. It has and always will be slightly more expensive than buy-to-let mortgage through your own name. But the gap has shortened. It used to be, I think there was times where Laurie was getting buy-to-let mortgages around about 2.2%, and I was buying everything through a limited company at 4.5%. So there was a big difference in the rates. That gap's closed a little bit, but the overall implications of being a sole trader now are just so substantial that you are not going to want to do that even with improved interest rates. So that's just a kind of broad overview of the different types of structure. You do have to also think about your objectives, because if I was sitting in front of someone, and this is why we say, 99% of the time we're going to be telling you to set up a limited company for your buy-to-let business, but it's never a catch-all. There's no global panacea, as the accountants would say. It depends on your specific circumstances. You might encounter someone that just wants to get 2 or 3 properties, and maybe their partner doesn't work, and they have the use of personal tax benefits that they can utilize against the income from these properties, in which case there might be a really solid reason why they choose to go down the route of sole trader rather than limited company. But anybody coming to us that just wants to get a couple of properties is probably in the wrong place. So we tend to find that 9 times out of 10, 9.9 times out of 10, a limited company is the only way that's going to make sense for you through your buy-to-let company. So let's talk a bit more about why that is. And ultimately, it comes back to Section 24. I don't want to bore you guys with this too much, because I get the point that most of you will already know what this is, but ultimately Section 24 that came in said that you could no longer get full tax deductibility of the mortgage interest when calculating your taxes. Now, that was a huge hit for most people, because it's one of your biggest costs as a property investor is your mortgage interest monthly. And to say, if you're a higher rate taxpayer, you're not going to get higher rate tax relief of that mortgage interest. We're going to take it out, we're going to tax you at the higher rate, and you'll get a 20% tax credit, which in the next slide I'll show you an example of this, and you can see how bad it can be for certain people. The beautiful thing about Section 24 is it doesn't apply to limited companies. So anybody that's investing through their own name is going to be hit by this, but it doesn't apply to the limited companies. There are some obligations though when you start a limited company, as most of you may have done already, is you have to file annual accounts. There is an annual tax filing to do. If you're having to pay corporation tax, there's a CT 600 to file. Generally, you would appoint your accountants to do that for you. They'll charge you normally about 250 quid a month, and you're paying that usually irrespective of how many properties you've got in your company. So if you've got one property that's only generating 250 net cash a month, all of that is likely to be going out to the accountant unless you know how to do it yourself. Alternatively, by the time you've got 10 or 15, you're still paying the same amount of money, and it really is much less relevant. You've got annual confirmation statements to submit. Again, if you've appointed an accountant, they'll take care of that for you, but it's a very easy form to do online. It's just a case of being prompted by the reminder from Companies House to do it and submitting the documents. You've got responsibilities as a director as well. Most of those fall down to the reporting requirements. So it's really just to give you a flavour that as it's necessary, you have to have a company for buy to let. And there are obligations that go along with that, and you have to make sure that you meet those obligations. And in some instances with this, there's cost. Okay. All right. Section 24 example. This is a similar example to the one that I give on the online training, but the example is broadly a situation where someone has £50,000 of annual rent coming in. The interest that they've got is £40,000, so it's a substantial amount of their rent. It's not a completely unrealistic scenario just now, because interest rates have doubled almost over the course of the last year and a bit. So if you were in a situation where you're on a LIBOR plus rate, then your interest rates have doubled, and we've been hit by that to a fair degree. So a scenario where their interest rates have gone up, they're now paying 40k out of their 50k of annual rent, and they've got 5,000 of other costs. So in reality, they're making £5,000 a year on their portfolio. Before Section 24, it would have been a simple case of saying, I as an individual own these properties. I've made an extra £5,000 this year net on top of my day-to-day job, and my day-to-day job is £45,000 a year, so I'm in the higher rate tax band, which is now 42%. So I'm going to have to pay 42% on that extra £5,000 of profit, and it would have been 2,100. Your total tax payable would have been 2,100, and your net profit after tax is 2,900. Right? Nice and simple. After Section 24, they said, okay, we understand you've made 5,000 of profit, but included within that 5,000 of profit is £40,000 of interest that we're not going to give you full tax relief on, so add that back. So we're adding the 40k back, which means our profit inclusive of that interest cost is £45,000, and we're going to tax that £45,000 at 42%, and that'll give you £18,900 of tax that you need to pay. What we will give you instead of the tax deductibility on that mortgage interest is we'll give you a 20% tax credit. So you can take £8,000 of that 40k as a tax credit, and that's going to leave a net tax payable of £10,900. So I think we all get that right. It's £18,900 less £8,000, £10,900 tax payable, which ultimately means he's only actually made £5,000, and he's now going to have to pay £10,900 in tax. He's losing £5,900 a year. So he has a cost of ownership of these properties that is just killing him. This is a situation we've seen time and time again around the time that Section 24 really kicked in. Well, it was a 4-year introduction period, so it was kind of really when RUD was kicking into our year where we had massive growth. There was just people that had to get rid of the properties because it was costing them a fortune every month. In fact, I think we're in the process of selling a portfolio just now that the guy's in a similar situation, because between interest rates and Section 24, he's just getting kicked in the nuts every month. So this is why investing as an individual for most people doesn't work anymore. It's why that you have to structure it through a company. Section 24 has been a massive hit. Again, if you've got any questions on that, I think most people are going to be pretty clear on it. The next stage is one of the most important tax avoidance strategies as a property investor. In fact, as an entrepreneur, it's one of the most important tax dodges that the wealthy use throughout history. The government can't tax unrealized gains, right? They can't. There's no way to do it because it'd be an absolute fucking mess. So an example of this is, say you've got a bunch of crypto, maybe you've got a bunch of Bitcoin, and Bitcoin's doubled this year. If they say you've just doubled that, so you have to be taxed on that this year, even though you've not sold it and you're still holding it, what happens next year when it halves again in value? Are they going to give you all that tax back? And moreover, who's actually valuing it? Okay, things like Bitcoin might be clear because there's an open market for it, but things like property aren't necessarily valued every year. So the tax man just doesn't know how to tax this stuff. And that's beautiful, because it means if you don't sell something, they can't tax you on it. And that's where the beauty of buy-to-let investment comes in, because the aim is to hold property for the long term. So you're not necessarily planning to sell it. What you are taxed on, though, is the rental income every year. And that will happen irrespective. So even if your property prices have gone up 200 grand this year, you're not going to pay any tax on that. But if you made 200 grand in net rent after costs, you're going to be taxed on it. This is the game. It's the biggest game within property investment. It's why Laurie and I went for the first 3 years without paying any corporation tax, because we played this game. So every time you've got a cost, the question is this a capital cost or is it a revenue cost? Revenue being against my rental income. Now, being a revenue cost is useful to me because it stops me having to pay tax on my rental income this year. Being a capital cost isn't useful to me unless I'm going to sell the property, which as buy-to-let investors long term, we're not necessarily looking to do. And if you hold property for a long time and you've got heavy capital costs on the front end, at the very least, the time that you've held it, you've lost inflation every year on that cost. So the moral of the story here is you want as much of your cost going through revenue and as little of your cost going through capital. And this is where the game is, right? So revenue is rental income. It's taxable in the year. Capital is the growth in the value of the property. The BRRR strategy fundamentally means that you're doing a lot of refurbs, right? And if you're spending 10 to 20 grand per property on refurbs, that means every year you're putting a huge amount of money out that has the opportunity to either be capital or revenue, right? And that's where the game is in property investment, is you want to maximize what you can justify as revenue from that refurb budget, and you want to minimize what goes in as capital, because your profit doesn't actually change. You're just moving it from one pot to the other, because if you put the cost in revenue, it means your capital gains are higher. If you put the cost in capital, it means your revenue is higher. Either way, you're making the same overall profitability, and that is the balance. So you're maximizing your profitability anyway. Why not put it into the bucket that avoids paying tax, which is the revenue bucket, right? So this is the game. And there was a story when we first started out and we had our first accountants. We moved after the first year, but they presented the accounts to us, and we'd done something in the region of 100 grand worth of refurbs in that year, and they put the entire amount without discussion as capital. And we'd have had a tax bill, and a fairly chunky tax bill in that year. And through a process of about, first of all, we shouldn't have had to pick that up. They should have done it for us, but they didn't know what they were doing. I would say a lot of accountants, unless they're property specialists, unless you're using the guys we recommend, they don't know that. And if your accountant's not having that discussion with you at the end of the year to say, right guys, you've had 100 grand of refurbs, let's go into this in detail. What's revenue? What's capital? What can we get away with here? If they're not having that discussion with you, there's something seriously wrong, because that was a 20 grand tax swing for us. And if we trusted our accountant and we didn't have a base level knowledge of that, we'd have paid way more tax by now than we had to. So it's really important to understand this game, because it's the biggest one you're going to play in terms of tax avoidance. Okay, so let's have a look at some of the definitions. So when the property is first brought onto the rental market, the expenditure to make it available to rent is capital. Now think about that. If you've just bought a property, what do you actually need to do to it to make it rentable? So compliance is going to be one of those things. If there's no compliance, if there's no interlinked smoke detectors and all that sort of stuff, very hard to argue that is not a capital expense, because, well, you need to do it to make it rentable. If you bought a property and there's no kitchen in it, again, hard to argue that you're not going to have to do that to make it rentable. But in terms of the standard of the property and where it is in the maintenance cycle, that's not as clear. That's not as clear-cut whether it's capital or revenue. Because restoring a property to its previous condition is a revenue expense. enhancement of the property will always be capital. So you can see through these definitions already, there's a lot of room for liberal expansion of what is what. And this is where the game starts, really. So, important to understand that you do a 10 grand refurb and there was compliance in there. Definitely was capital. There was no kitchen. So you had to put a kitchen in. It was uninhabitable without a kitchen. Those things happened and those are capital. But that's not to say that the entire 10 grand of that refurb is capital, because it needs to be broken down in its component parts. There might have been a bathroom in there that you'd said, you know what, it's avocado, don't like the look of that, I'm going to rip it out, I'm going to put a new one in. That is just a reflection of where it is in the maintenance cycle. That's a revenue expense because you didn't actually have to put the avocado suite in the bin to get someone in. You just did it to make the property more attractive. And there's always this argument of, see, because I'm doing this capital stuff anyway, I might as well do the rest of it that's just maintenance or revenue expense whilst I'm at it, because then I can get a longer term tenant in, they'll be happier, I can maybe bump up the rent a bit. Those are the arguments, and those are perfectly solid arguments that the HMRC would have to accept. So the following things are a revenue expense. The repairs that are routine, normal maintenance cycle. The price that you paid for the property was not affected by the condition of the property. When does that ever happen? That doesn't even make sense, because every price paid is reflective of where the property is in terms of its condition. The price was affected, but only to adjust for the position in the maintenance cycle. Now that's it. That's the one that kind of gets you of, this opens up the argument for revenue expense to a lot of different things, because all you're saying is, the price was lower because the condition, the flat's a tip, but it's just reflective of where it is in the maintenance cycle. Of course it is. I mean, what else would it be? It was reflective of the junkie that was in there before. Oh, well, I mean, we can still argue that's part of the maintenance cycle. And the asset could be used without the refurbishment work. So that's kind of the big one. If you've got a missing kitchen, you can't argue that it could have been used because it's uninhabitable. If you've not got smokes and heats and all that, then technically you're not allowed to rent it out. So again, you're going to have to look at classifying it as capital. But there's pretty much everything else is fair game for me in terms of justifying as a revenue expense. And because when you're growing your portfolio, you've got so many of these refurbs, you've got so much revenue expense that you can push through, you should never really be paying tax on your rental income. Pretty much tax-free. Now, the only downside of that, as I'll get to later, is if you've not paid tax on it, you can't take dividends. Dividends are only from taxable profits. So you can play this game and create a bunch of losses, although you're making money overall. There are other ways to get money out of the company with. But this is the biggest game at play. Make sure your accountant understands it. Make sure you have a broad understanding of it. What I would say is, when you're doing a refurb, take loads of pictures, keep them on file. Get a breakdown of your refurb budget so you can go through it itemized, item by item, and say, okay, that's revenue, that's capital, and I kind of know what I'm doing here. So you're in ahead of the game when it comes to the accounts, because the accountants are not going to do this for you in granular detail, and it is a very valuable exercise to save yourself a lot of money. Okay, so some other tax avoidance strategies if you've got your own company. Split the legal costs. This is a small one, but it kind of mounts up after a while. So generally you'd say the legal cost of buying a property is capital, because it needs to there's a process that needs to happen to buy a property, and it's just a capital cost of buying it. But if you're financing it, if you are taking a lender, bridging or otherwise, then technically the costs of that financing, any cost is a revenue expense. So what you can say is, my solicitor spent a bit of time buying the property and they spent a bit of time dealing with the finance, and the finance bit of it I can put against my revenue expenses, and obviously the bit of buying it has to go against capital. But if you get your solicitor to split the bill, and break that down into two elements, so their fee is split between the two, then again, it's just more revenue expense that we can push through and reduce our taxable liability in the year. It might only be 300 or 400 quid a time, but if you're buying a bunch of properties, it mounts up after a while. Home office costs. So if your property business is registered at your house, you can do it depends how many rooms you have. You know, it would be reasonable allocate one as an office. So say you've got 5 usable rooms in the house and one's an office, you can say 1/5 of the overall cost of your house is apportioned to the company in terms of cost, and costs would be the cost of your mortgage interest on the house. It would be costs of things like council tax and all that, costs of internet, costs of utilities. It's fairly substantive in terms of the amount of cost that you can put through, cost of maintenance of the property. Now, what I would say is, don't rip the hole on this one, because if you do, they will come after you on it. And what it can affect if you take the piss is your principal private residence exemption. So they would say, okay, you just sold your house. Well, you've been claiming for ages that part of that was associated with your business, and you've been taking the piss out of it. Then I'm not going to let you have the capital gains relief and all those beautiful stamp duty reliefs that you get on that element of it, because it's partly commercial, partly to do with the business. Now, they never go after that if you're reasonable with the cost. So like 1/5 or 1/6 of a justified cost of your expense can be allocated to the company. Training and education is another one where you can put the cost through for stuff like Rude Pro or books, or any of that sort of stuff that is relevant to what you're doing. The only thing that you can't get tax deductibility on is the acquisition of the original knowledge that you obtained to start the business. So usually what we'd say is, take an example of someone coming to do Rude Pro, go and buy a £5 property investment book before, and that is the original acquisition of knowledge, and then you can get full tax deductibility of Rude Pro through your company. So that's something to look at. Again, it's just more tax relief that you can get. Travel and subsidies. So most people that have a job will be used to this sort of thing, but you can put your travel expenses, when you're out and about on property journeys. A lot of people, again, take the piss out of this, but if you have a reasonable log of what you're doing, 45 pence a mile up to the first 10,000 miles, and then it drops thereafter. So you should be claiming these things at year end, and if your accountant isn't pushing you to do that, then you're probably not with the right accountant. And director's loans interest. So if you've put money into the business to start it, into your property investment business, then you're going to want to take some level of interest back on that loan, as long as it makes sense for you personally. So for instance, if you've got 50 grand in and you want to charge, say, 5%, 2.5 grand in the year, then the company gets the tax deductibility of that. You just need to consider whether or not you're going to be taxed on that 2.5 grand coming into your personal income, depending on what allowances you have. Usually people can receive up to £1,000 of interest tax free, but that starts to diminish if you're on an upper tax rate. There are also other ways that you can structure it to get higher rates of interest relief, but it's only when you're a lower earner. It's only when you're on sort of minimum wages. I'll talk about that in a bit when we talk about cash extraction in the company. But there's a game to be played with director loan interest. So if you put money in the first place, you're quite right in taking an interest out of the company, and the company gets tax relief on that. Just make sure you're not getting taxed on the other end. And you need to take the cash as well. That's the thing. A lot of people just accrue it and put it against a director's loan account. The tax man's a bit iffy on that one. You really need to take the cash every year out of the business. Even if you just put it back in terms of a new director's loan after that, it doesn't matter. But you should take the cash if you're charging interest. Everybody with me so far? Yep. Again, any questions? I know, as always, with this tax thing, I'm throwing a lot at you, but it's all there in detail online. It's just an opportunity to kind of go through some of the specific details a bit more clearly. Okay, next subject is company cash extraction. So if you've got business and you've made a bit of profit, or you've refinanced and you're not putting more money in, you're not going to buy another property, you just need that money back in the short term, or you used a credit card and you need to take it back out. It's important to understand what you can and can't do in terms of moving money in and out of your company and what the tax implications of that are, because ultimately with a company, you've got corporation tax to think about. Play the right game with the revenue capital thing, you're not going to be paying much corporation tax. But then you've got the next level of tax of how do you get the money from the company to you and make sure that that's done as tax efficiently as possible. So the first and most obvious thing is if you put money in at the start as a director's loan, then you can take it back tax-free, obviously, right? You put it in, you take it back. It's a loan. They owe it back to you. There's no tax implications of that. Now, just be careful, because the other alternative with putting money into a company to start with is you put it in as equity in the company, in which case the company day one has a value, because that 30 grand you put in, it's not owed back to you. It's not a loan. It's an asset of the company. Now they've got 30 grand cash and they're worth 30 grand. You're not owed that back. So there's a very few rare situations I could see someone wanting to put cash into their business as equity. It should never really go in like that. It should always go in as director's loans, because then you can get it back tax-free. You put it in as equity, you're going to have to be clawing it back through dividends or income or whatever. It just gets a bit messy. So if your accountant is advising you to put it in as equity, speak to us, because that doesn't make sense to me. Okay. Loan interest, we talked about that. If you've got a director's loan, you can take loan interest out of the company annually based on a reasonable rate, 6 to 8%, maybe slightly higher now because the market's gone up, but it has to be a reasonable market rate. You can't charge your company 50% interest on the director's loans this year because you're trying to get loads of money out. It needs to be a reasonable market rate, and 6 to 8% is usually what they say. I think you can maybe get up to 10% because the rates have gone up a bit since we did this. If you are standard employee, maybe even higher rate, you can get £1,000 of interest tax-free, so you can take £1,000 out of the company tax-free in interest. If you have structured your affairs in such a way that you are a starter rate, i.e. you're only taking your sort of 12,000 whatever a year of personal tax allowance, then you actually get the bonus of an extra 5k of interest that you can receive tax-free when you're on the starter rate. So you know that this is the 30k example that I do, where if you can take a minimum salary of just using up your personal allowance, then you can get the bonus of that extra 5k of interest receipt relief. You can pay yourself a salary. So if you or your partner or your kids are at an age where you can effectively hire them and they've not got another job, or you know they aren't using their personal allowance for whatever reason, you can put them on the books, you can pay them, and you can make the benefit of their personal allowances. You wouldn't want to pay yourself a salary if you were already a higher rate tax payer. It just wouldn't make sense. Pay your spouse or children, as I said, you can pay them a salary. You can claim expenses for business related items. Now, you know, even see if you look at some billionaires, if you go and look at let's say Richard Branson's tax affairs, you'll find that his income, his salary, is pretty minimal. Maybe a couple of $100,000, which for a billionaire seems absolutely insane. But what you'll find is the majority of his personal expenses are paid for by the company. Because if he's in Texas at his rocket Virgin Galaxy thing, then they're going to be paying all his expenses while he's there. You know, if he's in the UK, there'll be corporate accommodation that he owns that's just his, and you know he'll be covered there. There is a massive game to be played as your business grows and as it can sustain it to cover a lot of your personal expenses. Laurie and I's houses are cleaned and it just goes through the company. We've got our Rangers now, and again they just go through the company as a business expense. There's no personal tax implications for us because they're commercial vehicles. You can do a lot of that with electric vehicles as well. A friend of ours is has just put a new Tesla through his property investment business where he's got maybe 15, 20 properties. There's so many different business related things that you can get away with. Even dinners and stuff like that could be, business purpose dinners. There's massive games to be played with. So claiming personal expenses for business can be a really good way to limit your need to take a dividend or whatever from the company, because if it's paying for most of what you need, then why do you need it? £300 in non-cashable vouchers. Most people don't know that, but you're allowed to take £300 of vouchers that can't be cashed in, so like Amazon vouchers or Tesco vouchers or Morrison's vouchers. So it gets to the end of the year and you want to go and do some Christmas food shopping, then you can take £300 per person that's involved in the company out with no tax implications. You can pay yourself dividends on distributable profit. So I mentioned that if you're going to pay dividends, and everybody's got a £2,000 annual dividend allowance that you get tax-free. Beyond that, the rates are less than income, so it can save you money versus taking an income. But dividends can only be paid when you've made a profit, which means you've paid tax, which means you've not been playing too much of the games that I was talking about with the BRRR strategy and revenue versus capital. Profits can be distributed to shareholders via dividends. So, this is another really nice thing about companies, is you can add people on with shares that aren't really involved in the business. So if you've got kids that you want to pay some money to, they don't even have to be employees. You can just give them shares, and then they can take a dividend. And moreover, you can change what a type of share can do. So it might just be a share that doesn't give them the right to vote. It doesn't give them the right to the value of the company. It just gives them the right to a dividend. So you can pay them out a bit of cash every so often, and you can declare that dividend whenever you want. It doesn't have to be consistent with the rest of the dividend. So a lot of flexibility with companies. I talk a little bit about smart companies in the online module. Now that's quite advanced stuff, and it's not something that you're going to be looking at within your sort of phase one journey of property investment. So it's probably one not to get your head pickled by at the moment. If you're starting out a company just now in phase one, the lenders want to see it's you and you're a director and you're a shareholder and that's it. And you've not got any funky things going on with shares. We've got this smart company structure now, but we're dealing with commercial lenders. They don't care about that sort of stuff. They're used to it. The phase one lenders don't like it. So you need to keep things simple at the start. So that's company cash extraction. That example that I do online of the 30k tax out is really good because it brings all this together and it shows you how you can play a bit of a game and use a bit of everything to get 30 grand out of the company tax free. So check that out when you're online. I think it will help get your head around this process. Okay.
Echo, sorry, before you jump into that, a few questions just to clarify, right? Because I'm saying my piece, but it might not be accurate. So, firstly, Mickey's just asking about the declaration of equity. At what point is it equity or DLA? When do you do that, and how do you do it?
It would be automatically DLA unless they done something about it, and ultimately though, yeah, the accountant would have to do something to turn that into equity. It's not a case of the automatic assumption would be directors' loans, and I think 95% of accountants would always assume that you want it as directors' loans. I don't think they'd ever try and push the equity thing, but yeah, it can't become equity without you knowing about it. So I don't think you need to worry about having to do anything. If you put money into the business, it will be assumed to be director's loans unless you tell the accountants otherwise, or unless you've got a complete balloon of an accountant. But
all right, and Gusty says, can I put my baby who is 1 year old on as a shareholder?
I've had this before. I remember someone asking this, and
well, she just asked what age, and I said no, you can't add the kids yet, but what is the age?
There's some funky stuff you can do with this. The straight answer would probably be 16, but I think there are some funky things that people have done in the past to get really young kids on. I mean, the obvious thing is if you're looking for this for the benefit of your kids in the long term, and they're not of age, then a trust is really the way forward with that, and that's what Laurie and I have done. That essentially the shares are there for the benefit of the kids in the long run, albeit they're not capable of making decisions on it just now, so it's sitting with some trustees.
Cool. That's us.
Okay. Yeah, inheritance tax is the next one. Again, not something you can mess about with too much at the start of your property journey, because the banks just don't like it, the phase one lender. So inheritance tax is obviously a massive thing, and I give this example quite a bit in pro of a situation where, like Laurie and I are in just now, where we've got over 10 million worth of assets and say 6 million worth of loans. Property prices double every 12 years. So in 12 years time, that's going to be 20 grand, and 24 years time, it's going to be 40 grand, and you can see how it goes up pretty quickly. Especially when you're talking about lifetime planning. So you could be in a realistic situation in 36 years time where the assets are worth 80 million, and our debt would still be the same at 6 unless we'd changed, unless we'd refinanced a bunch of times in that period. You've created a huge amount of equity. You've created, £74,000 worth of £74 million worth of equity. That's a massive inheritance tax liability for your kids if you're not structured properly. And the problem with property investment or any type of investment business is it's not protected for inheritance tax the way a trading business is. So all this kind of funky stuff we're talking about having to do in property is because of the investment classification of buy-to-let. So trading businesses are pretty well protected from inheritance tax anyway. You can pass that stuff on to your kids without any major issues on inheritance tax. For investment, take Laurie and I's situation, if we popped our clogs in 36 years and passed the kids our buy-to-let business without really doing much from where it is now, they could be sitting with having to pay 45% of 74 million quid. And they'd have to liquidate all the assets to be able to pay that, and it'd be a real fucking mess and stress for everybody. So it is really important to plan for this stuff at some stage, and usually that stage is when you're in phase 2, and you've got the commercial banks on board, and you can start to have a bit more structure to it. But the best ways to deal with this, avoid the inheritance tax thing, is, well, there's two obvious ways. One is straight transfer of the shares. There is a 7-year survival on that, so they have to survive. But then you're passing the problem on to them. They're going to have to make sure they do the same with their kids before they die, or there's an equal mess. Or the other alternative is a trust. And trusts can be wonderful things because they're protected from inheritance tax. They're protected from things like divorce as well, because the assets sit out with your they sit out with your estate, so you don't technically own them anymore. They're in a trust, and you can still have a level of control over what happens to them because you're one of the trustees, as well as a panel of other people. Now, there's a beautiful thing within this smart company structure that is online, and I go in detail and I give an example, but fundamentally a smart company just means ones where you've messed about with the shares. And a share can do 3 things. It can give you voting rights, so you can choose what the company does. It can give you rights to the capital of the company, which is the value of the business. And it can give you rights to dividend, which is the right to take an income from it in form of dividend. So you can have different types of shares, and you can have types of shares that only have the rights to the capital of the company. So all the value of the company is in this one type of share, but you can't do anything else. You can't run the company, you can't benefit from dividends, you just have the value of the company. So if the company was ever to be liquidated, you would get all the value. And then you can have other types shares that have full rights to vote and full rights to dividend. So you can run the company, you can take money out of the company every year, but you don't actually own the value of the company. These are the sort of things you do in a smart company structure, where ultimately Laurie and I are left with these shares that allow us to run the company, take dividends as and when we want, but it doesn't give us the right to the value of the company, because the value of the company shares sit within a trust, and the trust essentially owns all that stuff, and it's there for the benefits of the kids in the long term. So if we were to die, they'd look at it and say, well, you've got these shares here that give you the right to run the company, but they're only worth the nominal value of the shares, which is like 200 quid. They're worth nothing. So it's not a taxable inheritance thing, right? So there's really cool ways to manage that. But as I say, it's something that you want to be looking at further down the line when you're on the phase 2 in commercial lending and you've got a bigger portfolio there. So that's, broadly speaking, inheritance tax. Last thing I'm going to cover on this, and then we'll open up for any other questions, and maybe there's other things we want to discuss. SaaS loans. For those of you who don't know what it is, a SaaS is a small self-administered scheme. It's a type of pension scheme that was specifically designed for small to medium-sized enterprise. There was a recognition from HMRC a long time ago that there wasn't a pension scheme out there that was right for small businesses, and they created a SaaS. And unlike a SIP or a standard pension scheme, a SaaS has a lot more flexibility in it, and so far as effectively what you get with a SaaS is an HMRC registered pension, an administrator, a bank account, and you pick what you invest in, albeit there are rules that your administrator is there to make sure you follow. So you can't buy residential property in a SaaS. You can't buy fine wine and classic cars into your SaaS. But aside from those obvious restrictions, there are wonderful things that you can do with a SaaS pension. You can loan from so if you have an existing pension pot that you want to transfer into your SaaS, you can loan money from your SaaS to your business and use that money for whatever the business does, including buying residential property. So whilst the SaaS can't buy residential property and it can't take security over residential property, it can loan you the money from your own pension to do it through another company. And then you have to pay that money back over a period of time, and there's an interest rate. But the interest rate is tax deductible for your company, and there's no tax to pay on the interest received by the SaaS because it's a pension fund. Very tax efficient. So that's, broadly speaking, one of the main things that a SaaS can do for someone who's got a pension pot that wants to use it in property but knows it can't buy residential property directly. There's ways to loan it. The restrictions there are you can only loan up to 50% of your total SaaS pot. So if you've got $200,000 in your SaaS, you can only lend up to $100,000 to your own SaaS, and then you need to find something else to do with the other $100,000. But you can buy commercial property, you can loan it to someone else on commercial terms at high rates. So there's all sorts of things that you can do with a SaaS. The other brilliant thing about a SaaS, if you've got a business, and I'm not just talking about buy-to-let investment, I'm talking about anybody that even's got a trading business, is you can put up to 40 grand, as anybody could, of pension contributions into that SaaS per year. So imagine your buy-to-let business has made 40 grand this year, and you've done all your tax dodges, but you've got 40 grand of profit, and you need to pay tax on that. So if you didn't want to pay that, you could put the 40 grand into the SaaS, out straight from the company into the SaaS, and that would be a pension contribution in the year. It would be a tax deductible cost. You would have no profit there to tax, so you would completely avoid paying corporation tax. And what's more is 50% of that value you can loan back to the company and use the money. So it's not like the 40 grand's gone to your pension. You can loan it back and still get the benefit of it. Now, the thing that really changes here is, for a trading company, That 40 grand limit I'm talking about is your personal contribution. But if there's two of you in the business, that could be up to 80 grand. The difference is with a trading business, up to £500,000 can go into the SaaS in a winner. So if you made £500,000 in your trading business in a year, you don't want to pay tax on it, put it all into your SaaS. You don't have to pay any tax that year, and you can loan up to 50% of that money straight back to the business and continue to grow the business. It's a huge tax avoidance strategy for people that have businesses. It can be used on a really good scale for buy-to-let. And, when Laurie talks about in finance, one of the opportunities here is to get other people that have got SaaSes and get them to lend to you, because that's just commercial terms. And quite often people that have got a pot of SaaS cash left are looking for opportunities and things to do with it. So it's a really good strategy. The other thing with the SaaS is, if you're doing a commercial or residential conversion like we did on our HMOs, you can buy the property into the SaaS. You can use your pension funds to develop that property to residential. The only thing you have to make sure is that you transfer it out of that SaaS before the water's switched on. So it can be as simple as, I'm fully finished my development, I've got residential properties, I've just not connected the water. I'm now going to transfer it out to my investment company, refinance it, get the money back out, and at that point I'll turn the water on, then we're done. So you can actually do these commercial residential conversions more or less entirely through your SaaS. We've done that with 14 Union Road. We took it all the way through development in our SaaS, and it can be a cool strategy. So I think SaaS pensions are a really interesting thing. There's a lot of tax benefits to it. That's why I mention it here. So that's been a comprehensive overview of property investment tax. I've been Alex Robertson. This has been the Real Wealth Podcast, and I hope you'll join us on this wealth journey.